Hey traders, welcome back. This is our weekly trading preview and market analyses for Monday, November the 28th. It's about 2.5 hours before the markets open up here Monday morning. We're in the pre-market right now, down about 30 points on the E-mini, sitting at a very pivotal point of 4,000. We'll get in, we'll talk about what's making the markets move this morning, what we're looking at this week, and some of our key important levels. All right, let's go ahead and jump into it here. There's a couple of things that we're looking at this week. Now, if we look at a weekly sort of indicator, and we use this on a daily basis inside of our trading room, we feel like it is really important to have multiple overlays, and we look at daily numbers, we look at weekly numbers, and then we look at monthly numbers, and we'll look at all of those here today. But these are our weekly numbers. We're still very strong in terms of our buy signals pretty much across the board here with regards to the E-minis. However, most of our indicators, as you can see, are starting to flash overbought at this point. We are overbought on a lot of our indicators. Volatility, ATR, has absolutely just dropped out of the marketplace. You'll see here in just a second, we don't have any volatility. That's not good for option selling. And we have this sort of juxtaposition that we need to work through here, where we're still battling, we're still having trouble getting above the 50-day moving average. We've got these pivot points right around 40.20, which is where, incidentally, we've been battling all night long. We get up to that 40.20 level, we get knocked right back down. We get knocked down just below the 4,000 level, we pull it right back up again. So there is an absolute battle going on here right now with regards to these technical levels that we're sitting at. But we are still in a bullish pattern, albeit it is getting a little bit long in the tooth here. So we take a look at a couple of our key support and resistance areas. This is the E-mini futures contract. This is the ES, and it is on a daily basis. And you can see some of these key levels that I wanted to point out with you. The real key levels here, I think, as we look at these areas of support and resistance, first and foremost, it is right in this area, right in here. Right in here. So this area right in here, you're talking about 39.54 on the downside and 40.96 on the upside. So this is the battle zone, I believe. This is the battle zone for today. We'll have to see what the market can do with that, but I think that's the real critical question for today is can the bulls get back above 40.96 and continue this trend to the upside, or do the bears start to get a little bit of momentum? Obviously, breaking down below 39.54 here would not really change the overall trend from bullish to bearish, but it would be a good start for the bears. And so that's really the first levels that we're looking at. Now, if we pull it down a little bit closer and we look at a 2-hour candle, this gives us a little bit more definitive areas of support and resistance. And I'll give you sort of my numbers here that I'm looking at for today. So on support, on the support side here, as we look both up and down, 39.90. Now we're sitting in right about 4,000 right now. So the market would need to, for the bears to take a little bit of charge here, would need to break below 4,000. And then 39.90 is the next level down, and then 39.83 down below that, 39.73 down below that, and then 39.53. 39.54. Now we get below 39.54 and we're back down into this previous consolidation range, and that would basically nullify all of the action from about November 22nd, so about the last 6 or so days of this bullish push that we would had, and it would bring it right back down into a very neutral rating in the market. So 39.54 is a real key number for the bears. On the bullish side, when we look at resistance up here, we're looking at, again, obviously the 4,000 level. That's a big demarcation point right now. We're sitting on it right now as we speak. Above 4,000 would be 4,012, and then above that is 4,030. Above 4,030 is 4,049, and that's a big one right there. Above 4,049, we could get back into, that's right up in here, we could get back into pushing to higher highs. But that's going to be maybe a big task for today. What's happening today? What's pushing the markets around? Why are we down this morning? Well, we've got a couple of news items taking place. Number one is the China lockdown. They have a zero COVID policy, tolerance policy there. And so they are back to a full lockdown. There was a lot of hope. There was a lot of optimism that China was going to reopen their economy, that was going to help basically world economies, that was going to help inflationary issues as well. It certainly doesn't look like that is going to be the case. There's been massive countrywide protests in China, which is something that you don't really ever see. COVID, of course, on top of that, is flaring up, not just in China, but in other parts of the world as well. All of those things are combining along with the Eurozone's numbers today out on inflation. Inflation is still rampant in the Eurozone, absolutely through the roof, really. And then you've got, on top of that, you've got crude oil collapsing. We have been talking about crude oil for the last week and a half in our trading room, and we've been working very diligently to dissuade all of our members from trading anything that resembles bullishness in oil at all. There is some, I think, serious downside here in oil. Oil is getting pressure today. Obviously, China, one of the biggest users of oil, basically shutting their economy down. That's not good for oil. You've got the group of 7 working on trying to figure out their price cap for oil come December here. All of that is very bearish for oil right now. So we do actually do a weekly ladder trade in oil, and we are looking pretty much at it from a bearish standpoint right now. I know oil has obviously had a really nice run as of late. Looks like that might be coming to an end. So those are the things that are affecting marketplace right now. These are the levels that I'll be looking at. If you look at it from a little bit bigger perspective here at the major indices, we use the ETFs, the SPYs, the Qs, the IWMs, and the diamonds. You can see that we do have the IWMs trying to break out. The diamonds have just been ridiculous. The diamonds have been unbelievable, but the diamonds, the Dow is sort of a messed up index, really, and it's not really indicative of what the market does. Obviously, it's down to 30 stocks, and 4 of those 30 stocks really control, cap weighted, really control the whole entire index. So anytime 4 stocks are running your index, it's probably not really necessarily indicative of what the overall market is doing. But nevertheless, the industrials have just been absolutely on a tear. But you can see that they're up against a pretty decent resistance level. And I think that with this run that the diamonds have had, it's going to be a tough go to continue that push up, at least without taking a little bit of a pause. And so again, I think all of our markets, all of the markets that we look at are sitting at very, very critical demarcation points. I say this, it seems like every week, but we're at some crucial levels here. And I think where we end up at the end of the week here will be telling. Man, we've been in a very, very consolidating market now for almost 2 weeks. Lots of inside candle days, lots of low volume, lots of low volatility. That always leads to expansion. Contraction leads to expansion. Expansion leads to contraction. That is a given in the marketplace. We just don't know when it's going to happen. But I think that, again, whether we're going to come back down to some of these previous levels here, or we're going to shoot up. We're going to take off to the upside and finally break out. I think we're going to start to see that happening here sooner rather than later. We'll find out. There's a lot of earnings coming out this week. I will be honest. There's not a bunch of them that I am really that interested in setting up a earnings trade around. But there may be a company in this mix here that is something that you're interested in. You can take a look at those. But again, this is a fairly decent week for earnings, but nothing that I really am that interested in building a trade around for this week. We look at sector rotation. We look at the major sectors in the marketplace. We look at them on a 1 week basis. You can see that last week really it was pretty much green across the board with consumer discretionary stocks leading the way. Technology still hanging in there. It's had a really nice run as of late, but keep in mind, and this is always something that I mention is something that's important, that what usually leads us up is what usually leads us down. And so again, I think you're going to start to see that weakness come in the energy sector. I think you might start to see that weakness come in the tech sector as well, if in fact our next move is to the downside. If it's not, you'll probably still see these leading indicators heading up, except for I would put an asterisk here or a star on energy. I think that there's going to be some pressure there on the downside with regards to that area. We look at news for this week, and it really is Wednesday and Thursday of the week. We've got ADP numbers on Wednesday as well as the GDP estimate. I'm very, very interested in seeing what the GDP estimate is. If you look at the yield curve, you look at there's been so much talk about the inverted yield curve and what it implies and what it implicates into the market in terms of potential. I think it's going to be the number to watch this week. I'm very, very interested in seeing what GDP numbers look like. My feeling is that I don't feel like we avoid a recession. I've been wrong before and I could be wrong now, but we'll see. And I think the GDP estimate will give us at least a little bit more transparency in terms of where we're heading there. We've got crude oil numbers coming out that is important for us because we're going to be building some crude oil trades here this week. So that'll be an important number for us to watch. We've got the Fed's Cook and Powell both speaking on Wednesday. Cook starts at 12:30 Eastern Time, and Chairman Powell starts at 1:30 p.m. Eastern Time. So those could both potentially be market-moving news. Later Wednesday evening, this is not something that will affect our trading in the cash markets on Wednesday because it will be in the evening, but China's PMI number comes out later Wednesday evening. It could absolutely affect the futures market, and thusly it could potentially affect our ability on Wednesday to put a overnight theta ferry trade in. So we'll have to look at that very closely in terms of what the premium available is on Wednesday and see if that's a day that we might want to maybe pass on our theta ferry trade. That trade's just been phenomenal for us, but we want to make sure that we're putting it in appropriately, and it doesn't apply for every day, even though we have had pretty much every day an opportunity to put that trade on. So we'll look at that on Wednesday, but keep that in mind for our theta ferry trade on Wednesday. Thursday, we've got jobless claims as well as consumer spending coming out in the morning, and a little bit more Fed speak taking place at 9:15 a.m. Eastern Time. So those are really the pre-planned news catalyst that could potentially move the market. You can always have something else come out, but that's what we've got on the agenda for right now. We look at the heat map over the past 2 weeks. This is 2 weeks ago, and this would be last week's right here. And honestly, they're both very healthy. They are both very, very healthy heat maps. You don't ever want to see a heat map with all red or all green, because that just means that's an extreme day. Those days never last, and whether you're bullish or bearish, you want to see a little bit more of a mosaic sort of look to this. It's been a pretty good couple healthy weeks for the marketplace these last couple of go-arounds. We look at our results from 2 weeks ago right here, and then last week's. Again, it was a pretty solid overall week for the marketplace. Not too much to complain about if you were a bull in terms of what the markets did. I will again point out the outperformance of the diamonds. Again, I don't think that type of performance continues. One of two things is going to happen. It always seems to over time, and that is that these numbers are either going to catch up with the DIAs. These other numbers are going to catch up, or the DIA is going to slow back down. But you just don't have this sort of outsized performance for very extended periods of time. It happens obviously in short periods of time, but it also, I think, points to why it is important that we, as members of our live trading room, trade all of these. We do build a specific strategy, a specific trade around each one of these. They are all a little different. We have a specific strategy here with the DIAs. We use ladders, and we do it in a longer term scenario. We have a credit strangle that we put on weekly with the IWM. We do 4-day to expiration trades here on the SPYs and the Qs, but we usually will start them and scale into these from opposite sides. So it is critical, I think, if you're going to trade one of these strategies with us, that you trade them all to get that diversification. You can see, again, on a week in and week out basis, they do vary by quite a bit. We look at the put to call ratio. Now, we've had a lot of neutral ratings on the put call ratio here for quite some time. Remember that the put call ratio, it's an indicator that shows the put volume relative to call volume. Puts are generally used to hedge against market weakness or bet on the market going down. Call options are used to hedge against market strength or bet that the market is going to go up. So the put call ratio is above 1. That is the critical number. It's above 1 when put volume is greater than call volume, and it's below, so it's above 1 or below 1 when call volume exceeds put volume. So again, this is a way to gauge market sentiment, and sentiment is deemed bearish when the put call ratio is high, and it's deemed bullish when the put call ratio is low. So very interesting as we look at the put call ratio. We have been just treading water down here on the put call ratio forever, it seems like. Last week's put call ratio is 0.8. Nothing really to write home about, nothing exciting. Well, this week we've got some action. This week we've got some movement. That's a big put to call ratio, and that's bearish. That's very, very bearish. Will it play out this week? Well, I don't know, but that is one of the key indicators that we look at. We look at the fear and greed index. The put call ratio and the VIX are part of that greater index. So the put call ratio is a big factor in that. You can see that big spike. That's of note. That's something that we shouldn't just simply brush off. Okay. We look at our expected moves for the marketplace, and you can see it is just hammered down. Volume is low, price action is weak, and candles are small. I don't know what to tell you. 76 expected points of movement this week, I guess, is better than last week's 72, but it's not great for option sellers, guys. The premium is not anywhere near what it was, obviously, just a very, very few short weeks ago when we were 120 plus. So everything ebbs and flows. Everything changes as time goes by. This too will pass. This too will change. But for right now, it's tougher for option sellers. There's no question about that. We do look at the Fear and Greed Sentiment Index, and it takes into account a lot of things. It does take into account that put-call ratio. It does take into account the VIX, and we're going to look at both of those separately here. But it takes into account a lot of other aspects as well. And the idea with the Fear Greed Index is that it's just a contrarian indicator, meaning when there's a lot of greed in the marketplace, when there's a lot of prevailing sentiment that we're going higher and that everything is hunky-dory and everything is fantastic, that's probably a time to get short. When people have extreme fear, when they're jumping out of windows, when people are going bankrupt, probably a time to jump in and buy, right? So we're not into that extreme greed area yet, but man, we're pushing up there. There is a lot of just sort of passive, I'm going to put my money in and see what happens at this point. We're not really any different on our reading from this week to last week, but we're up there. We're up there in the greed index. And again, we want to take a look at all of the factors that go into this. The put-call ratio is one of those. The VIX sentiment reading is another one. And, you know, I've been very critical of the VIX for the last year, really, 6 months at least. The VIX has pretty much been broken. It really hasn't given us the responses that it normally does in this marketplace. But of course, the idea with the VIX is that when the VIX is high, it's time to buy. When the VIX is low, it's time to go. So again, this is a volatility or a sentiment reading. And when there's a lot of fear and there's a lot of volatility in the market, meaning the VIX is really high, that's probably a time to go. It's probably time to get out of the marketplace or short the marketplace. When volatility is absolutely through the floor, it's low, everything is calm, everything is stayed, it's probably the time to go, right? So when the VIX is low, rather, I think I said that backwards. When the VIX is low, it's time to go. When the VIX is high and there's a lot of fear in the marketplace, that's the time to jump in. So we have a very, very low VIX sentiment reading right now. That's pretty low. I don't know if it necessarily means that we're going to have a correction and we're going to come back down, but it certainly implies it a lot more here than it does here. So we've had probably, this is from the middle of October, the VIX has, as the markets have gone higher, the VIX has come lower. And so again, all of these things are sort of lining up here along with these geopolitical events that we've talked about this morning to say that maybe we are going to have a little bit of a turn here in the marketplace. We look at the S&P and the open interest sort of gamma levels that we always are so interested or keen in looking at. And again, for me, this 4055 level, 4100 level, 4000 level, 3950, and 3900 level. Those are critical levels. So 3900 is a big level, 3950 is a big level, 4000 is a big level, 4055 is a big level, and 4100. These are all real critical levels in the marketplace. That's where all the open interest is sitting. That's where all the action is sitting. That's where you're going to have big gamma walls come into play. And these can be magnets. These can be magnets in the marketplace to try to suck the market into these areas. So again, make note of your levels this week for the overall market. Make note of your levels on a daily basis and allow those to run your trade so that you feel comfortable with where you're putting your levels at. That's it for today, guys. That's our overview for the marketplace. If you do want to try out our live trading room for free for 7 days, you can come hang out with us. You can come trade with us. You can come commentate. You can ask questions. You can interact with us. You can do it for free for 7 full days. Just go to tryzerodteforfree.com. We'd love to have you come join us, trade with us for a little bit. We believe that we are the premier live trading room online today. I think our numbers back that up. But come check us out if you'd like. We'd love to talk with you. And I hope you guys all have a great trading week. It was nice to have a little bit of a vacation last week. And we finished off the week really strong on Friday. So let's see if we can continue that string of successes this week. Take care, guys. Hope you have a good trading week.